Identifying market trends is crucial for retail investors. Trends can indicate the general direction of market movement. Recognizing these trends helps in making informed trading decisions. One critical first step is understanding the types of market trends. There are three main types: upward trends, downward trends, and sideways trends. An upward trend is characterized by higher highs and higher lows. A downward trend shows lower highs and lower lows. A sideways trend occurs when the market moves in a range without a clear upward or downward movement. To identify these trends, investors can utilize various technical indicators. One popular tool is the moving average. This indicator smooths out price data by creating a constantly updated average price. Investors commonly use the 50-day and 200-day moving averages. A crossover of the short-term moving average above the long-term moving average often indicates a potential upward trend. Conversely, if the short-term average crosses below the long-term average, it may signal a downward trend. Another essential tool is the trend line. Drawing a trend line can help visualize the direction of price movement. To draw a trend line, connect the most recent peaks or troughs. A rising trend line shows support in an upward trend. A falling trend line indicates resistance in a downward trend. Observing how prices interact with these lines can provide insights into potential reversals or continuations of trends. Volume is also a critical indicator of market trends. An increase in volume can confirm the strength of a trend. When prices rise accompanied by high volume, the trend is considered strong. Conversely, if prices are rising with low volume, the trend may lack conviction. Analyzing volume alongside price movements allows for better assessment of the trend's reliability. Chart patterns offer another layer of analysis. Patterns such as head and shoulders, flags, and double tops can indicate potential trend reversals. For instance, a head and shoulders pattern typically signifies a reversal from an upward trend to a downward trend. Identifying these patterns early can provide strategic entry or exit points for investors. The Relative Strength Index, RSI, is a momentum oscillator. It measures the speed and change of price movements. The RSI ranges from 0 to 100. Generally, an RSI above 70 indicates that a stock may be overbought. An RSI below 30 suggests that it may be oversold. Using the RSI can help investors determine the strength of a trend. This information can inform decisions on when to buy or sell. Another commonly used indicator is the Moving Average Convergence Divergence, or MACD. This indicator consists of two moving averages and helps identify momentum. When the MACD line crosses above the signal line, it can be a bullish signal. Conversely, a crossing below might indicate a bearish signal. Understanding MACD signals can enhance trend analysis. Fibonacci retracement levels can also assist traders in identifying potential reversal points within a trend. These levels are derived from the Fibonacci sequence and represent key support and resistance levels. Investors can use them to assess where a stock may pull back before resuming the prevailing trend. Market sentiment should not be overlooked. Investor sentiment can significantly impact trends. Bullish sentiment generally signifies optimism, potentially driving